but also a very difficult time if you advise foreign investors on real estate. Something I call this new FIRPTA exemption, which is like something that is not that new anymore. It's about a year, like since December 2015. Obama signed into law what we call the Protecting Americans from Tax Hikes Act of 2015, a very interesting naming convention for this act. This act, surprisingly, which wasn't expected, had a new law built in, which is what we call a new FIRPTA exemption. FIRPTA, to most of you, I think you're familiar with FIRPTA, means any foreign person that sells real estate in the US at a gain is taxable in the US and pays, depending on who you are, roughly 35% tax. That was the main hurdle for many investors to enter the US and structure real estate investments tax efficiently. Now, we already had few exemptions in the US from FIRPTA. One was for REIT stock sales, if a foreign person sells a REIT stock in what we call a domestically controlled REIT, a REIT that is owned more than 50% by domestic US persons. That's certainly interesting, but it's kind of narrow because the market for REIT stock sales is there, it's growing, but you have to have a very appealing portfolio or a very appealing trophy asset in a REIT for a buyer to be willing to go through all the hurdles that come with buying REIT stock. As opposed to selling the asset. So asset sales are still the predominant kind of like transaction mechanism in the US, but REIT stock sales become more viable, I think more popular, depending on the asset, of course, and the buyer. Now, we had another exemption which was provided for a foreign investor that owns not more than 5% in a publicly traded company. If such an entity were to make capital gains distributions, those were not FIRPTA, they were recharacterized in passive income, so there is no filing requirement or no FIRPTA tax. Now we have an increased hurdle. We can invest up to or not more than 10% in publicly traded REITs, and any capital gain distribution by that publicly traded REIT to a foreign investor would not be FIRPTA. So that kind of increases the universe of potential investments free from FIRPTA tax. But now this rule came into play in December 2015. It's very relevant for pension funds, and I work for many pension funds, not in Germany just, but Switzerland, Malaysia, Kuwait, Qatar, elsewhere, and it's very welcome. But there are so many uncertainties with that law that many investors who normally would qualify or should qualify do not really know if they in fact qualify. And I want to go with you through what the requirements are, and then later on I will tell you what the benefits are. So let's start with the tough stuff first, and then the good stuff follows thereafter. The requirement is that any foreign pension fund that can be in the form of a corporation, an organization, an arrangement, or a trust that is formed under foreign law, not in a country that is not the US. So that seems to be fairly easy. Question is, however, like a Versorgungswerk, a German pension fund, might not be established under federal law, but under law of a municipality. So that bears the question, is that already like an issue with meeting the requirement? I don't think that's an issue, but some people might argue it could be an issue. The other requirement is the fund must provide retirement and benefits, pension benefits to participants or beneficiaries of a former or current or former employee of one or more employers for services rendered to that employer. That normally tells you the typical company pension fund is clearly one that we would think is qualified if other requirements are satisfied. But this requirement, employer-employee relationship, is very difficult because if you look at German Versorgungswerke, they provide benefits to self-employed people based on professions. So, and that's a big hurdle. The good thing is in March 2016, what we call a blue book by the Joint Committee on Taxation was issued, and this blue book usually provides guidelines on how to understand tax legislation of the prior year. In that blue book, it was mentioned that it's not binding law, it's just like general explanation, that one should not apply these rules so narrowly. We should also look at multi-employer pension funds, but also those that actually are established for one or more employers or professions. And that kind of suggests that the legislator had in mind also like the typical Versorgungswerke, who provide benefits not to employees of an employer, but to certain people who are of certain professions, like doctors, dentists, etc. So there's some support to argue that Versorgungswerke, German Versorgungswerke, and other pension funds who provide benefits to self-employed people should also be within the scope of application. The next one is an easy one. No single participant should have access to more than 5% of the assets or the income. That's easy for a typical pension fund. The next one is the one that causes us the most trouble. which says the fund must be regulated. That's fairly simple and normally easily met. However, there's one requirement. The pension fund must annually report about its beneficiaries to the relevant tax authorities. So some countries I work in have no tax authorities because there's no income tax system. There's no relevance to reporting whatsoever. Some other countries do not report to the tax authorities. They might report somewhere else or not at all. Or the question is also what needs to be reported. Contributions, withdrawals, distributions, it's not quite clear. The legislator failed to make any cross-references in that law to any other existing law in the US tax code. So therefore, it's really difficult to find support to kind of conclude reliably as to whether a certain pension fund that doesn't clearly meet all these requirements actually does qualify. It's a tricky situation right now because we expected for the past 6 or 7 months guidelines, a notice, or some other treasury regulations. Nothing came out. There was an attempt made in December last year with a corrections bill, which didn't go to the Senate, which had some clarification, some simplification, which however didn't make it to the Senate, and therefore it was not approved. So we're still waiting now if this is going to be clarified by way of tax reform as a package, or whether it's ultimately regulated or ruled with based on notice or other regulations. So it's quite interesting when I talk to pension funds who also would like to take the benefits and think they qualify, which they should based on policy intent. Unfortunately, the law is not clear, and we have to wait until we get clarification on the law. Lastly, the last requirement is fairly easy. That deals with that the income or contributions by a beneficiary or participant to the pension fund should not be taxable to the pension fund, as well as income earned by the pension fund should either be tax at a reduced rate or deferred. So normally, most pension funds I have come across are either fully tax exempt or are taxpayers in the first place and but an exempt in the second step. So that should normally not be a deal breaker for most. So I went through this already with you as to what are the main areas of concern, because there is plenty of concern. I work with a pension fund from overseas. They have, again, there's not income tax system. So the question is, how do you meet a reporting requirement if there is no tax system in place? What's the relevance? This was actually taken from FATCA, which you all are familiar with. That kind of copy-pasted from FATCA to try to avoid tax evasion. But in a country with no income tax laws, what evasion could there be? So it's very half-assed, I think, thought through, and hopefully we get clarification fairly soon. I want to just go to what actually makes this law so appealing to a pension fund. And the appeal comes with the fact that in the past, every pension fund that I deal with is very conservative. They don't want to have a US tax filing requirement. So you go into a REIT structure in the US typically and have an asset. If you sell the asset, the gain would flow through the REIT up to the foreign investor and would trigger FIRPTA and therefore a US filing requirement as well as tax. This new law now provides an exemption from FIRPTA for both asset sales by a REIT, but also as stock sales by a foreign investor regardless of its ownership. So I can own my own REIT 100% or a majority owner and still exit tax-free. And that's a huge relief for most investors to ultimately not be at risk of being subject to a high 35 or combined 55% US tax rate on asset sales or on stock sales. So it gives you a lot of more options investing in the US. Of course, the asset must be requalifying. And that's some people misunderstood, I think, the law. The law does not change federal tax laws. This is only a very targeted exemption for gain from the sale of real estate. But if you own real estate in a partnership structure or directly in a pass-through structure and you sell that at gain, you are still paying tax. You are exempt from FIRPTA tax, but you still pay tax on the income because it's viewed as from a trade of business. So the exemption is limited ultimately, essentially, only to REIT structures, where a foreign investor or a pension fund goes into a REIT structure and sells the REIT stock or the asset, okay? So it's a fairly narrow application, but it's relevant for investing strategies. Another helpful tool also provided is that you do not have to own the REIT directly. You can ultimately own the asset through a partnership structure, then holding a REIT, or even through your wholly owned foreign corporation. So let's say a German pension fund can form, like say, a Swiss or like a Luxembourg fund vehicle that it owns 100%, like an Einanleger fund, for example, and goes into a REIT. And if the ultimate investor is a QFP, so is the 100% held subsidiary. So it allows you more structuring flexibility ultimately. The problem is the law is very strict again. It says a interposed corporation that is owned by one or by a QFP. So if you have a fact pattern where you have one corporation owned by 2 qualified pension funds, you would technically not be within the law. And that's also one of the uncertainties that we deal with right now, and we hope to get clarification. I'm getting close to, I think, my allotted time, but the way how you go into a fund structure and want to take the position that you are QFP, if you're a pension fund, is by simply providing a statement to the withholding agent that has to be signed under penalty of perjury that says, okay, I'm not a non-US person, so you are a US person for that purpose. That's the way the law deals with QFPs. You have to get an EIN number, like an employer ID, like a tax number, and you have to sign a penalty of perjury. So it's a very high standard. So people a little bit shying away from giving that statement because the law is uncertain. But some pension funds I've worked with have done so because this will only apply once you have a gain event, which is likely not happening anytime soon unless you go into an existing fund product that sells and buys regularly. I want to just show you just again to make it simple for you to understand what the relevance is. So on this page, I show where it's relevant. So let's say you have a German Volksversorgungswerk, a German pension fund, very simplified, that owns assets through a REIT. You can own majority or minority of the REIT stock and sell REIT stock tax-free if you're a QFP, but also the REIT can sell the asset and distribute the gain by way of distribution tax-free. So that's the most basic application. The next one is you hold it through an LP, a partnership that owns the REIT. So here you can sell the LP, the REIT, or the assets. So you get out tax-free. The next case is now, what I mentioned the last few minutes, is if you form a non-US subsidiary that you wholly own as a QFP, then you can also hold a REIT stock, sell a REIT stock, or the assets tax-free. Now to the areas of uncertainty or where it doesn't work right now. If a qualified foreign pension fund owns US real estate assets directly, and they are ECI generating assets, then you can't sell tax-free, even though you're not subject to FERPTA anymore, but the gain is still kind of linked to the US state of business, and therefore you still pay tax 35% plus branch office tax. The next one is the same structure, LP structure, indirect owning real estate. Again, doesn't work. You can't rely on the QFP exemption. And the last one is the one of uncertainty, where I'd say you can take a position where like 2 QFPs, be it 2 Germans or 3 Germans or 10 Germans, or non-US pension funds, all QFPs, form their own like investment vehicle, like a pooled vehicle here, and go into a qualifying structure. Because the law says a wholly owned entity, so by one QFP can be interposed, but currently there is no support in the law or by regulation or by any authority that you can actually have a multi-QFP owned interposed entity. So there's some uncertainty. One get to a position to support this, but it's not quite clear at this point in time. So we all hope to get some clarifying rules or notices out sometime soon, but with tax reform upon us, also uncertain, we just simply don't know where we come out. Any questions you have afterwards, happy to take those. Thanks, Brad. I think we will go on time.
You're on the mark.
Perfect, okay.
Thank you, Oliver.
Thanks.
There is a wealth of information in that presentation, and I would suggest if you look at the handbook, you'll see the details, and certainly reach out to Oliver for more discussion about it. This whole FERPTA change has potential to change the game for foreign pension funds. Ultimately, we will get regulations and we'll know what the new law means. We're going to take a 15-minute break, be back here at 3 o'clock, but I would like the sponsors and speakers to come up to the stage. We're going to get a group photo before we make the next session. So 15-minute break, we'll see you back here at 3 o'clock. Thanks very much.